I'm Ollin Sykes, along with Scott Sykes with Sykes Company, CPAs and advisors to pharmacies across the country. And with us today is Jared Barton with InventoryIQ. He's actually out of his Alabama office today. It's our pleasure to have you today on the next series of the Master the Margin, where we want to make this obviously as conversationalist as possible, where we're going to discuss inventory best practices, which is essentially keeping your cash in the bank and not on the shelf and getting those inventory turns flying out of the door. That's the main thing we want to try to do today is teach you how that a lot of pharmacies are doing this very well with Jared's help. Just a quick disclaimer, this is for general information purposes only. If there's a takeaway that you gather from the conversation today, please reach out to your professionals for your own individual advice. And again, we're tickled to death to have everybody with us today. And Scotty, you want to take it from here?
Sure. So we'll just start off top here and inventory the big picture. So what we typically see, all successful pharmacy owners share one common goal, and that goal is control and management of their inventory. That is a very common thing that you're going to see throughout all those successful pharmacies. And the better you manage that inventory and cost of goods, the more money and better your cash flow. That is just proven time and time again. And Jared, I'm sure you see that all the time. I mean, you're in pharmacies every single day, pretty much. I mean, tell me what your views are on that, or common denominators y'all see there.
Absolutely. I think it's something, first of all, thanks for having me, guys. But I think it's something that is almost something that you have to do, and the consequences of not doing it more or less push you closer and closer to failure. You know, there are certain things that you can get by with. We kind of talk about some of the secondary pursuits within the pharmacy business a lot of times when we're just conversing together. But I think that some of the boxes you have to check, you know, kind of a cost of admission type thing, is inventory management. I don't think there's any way around it at this point. And you guys could tell me, for the aggregate of your customer base, what the average cost of goods is by my, by my reading and things like that. It typically comes up somewhere between 75 and 78% is a cost of goods figure. And so if you thought that you could manage 78% of every dollar that you were going to spend this year by doing one thing or by having one primary focus, I would think that most people would want to focus on that.
And Jared, we couldn't agree with you any stronger. And that really is a good way to look at it. When you look at about 78 cents a dollar of every dollar that comes to your pharmacy being involved in either how well you buy and how well you manage that inventory, nothing can move the needle any quicker, 1 or 2 percentage points either way, which on a $4 or $5 million store even makes a humongous difference over the course of the year. So clearly, unfortunately, we don't see the emphasis placed on inventory, particularly perpetual inventories. And I know we're going to talk about that some in today's production here. But that and being able to know what those inventory levels are at the end of the month is so critical to making sure that you've got accurate gross margin numbers at the end of each month, not only at the end of the year.
That's right. Now, I want to mention also, I think we didn't mention earlier, please put in your questions in the chat box or in the questions box, and we'll answer those as we move along here. So this is your chance to ask any questions you have. But leading into this, you know, I think bottom line here is inventory management is vital. I mean, you've got to have that mindset in your pharmacy, and not only is it vital from a cash flow perspective and everything like that, but it's a very important component of your balance sheet and profit and loss statement. And any material differences in that inventory number on your balance sheet is going to impact your profit and loss statement. For example, we've seen an instance where inventory maybe was $500,000 on the balance sheet, but in reality it was $200,000. So that $300,000 difference actually inflated their income, and you know they were paying tax on $300,000 of just profits that were not there. So it's vital that this inventory is also tied into your accounting system, and we can get accurate information. Accounts payable also links into that. So when you have inventory wholesaler outstanding at the end of the month, what you owe that wholesaler is at the end of the month, that should absolutely be in your accounting system as well. The accounts payable portion, the inventory, the cost of goods, they all talk to each other here. So those have to be accurate and reconciled month in, month out. And we're going to go through an example here in a little bit and show you how that works. Obviously, we're talking about $100 bills on the shelf here. Like Jared said, 75, 78% of your cost of goods there is a lot of money. So $100 bills on your shelf, get this off your shelf, get it in the bank account. And Jared, guessing is not a business strategy. I'm sure you probably see that from time to time.
A ton, and to the point that I've actually been kind of discussing with my alma mater. There's a particular girl there that works as the liaison for the School of Pharmacy about doing a class, just a business focused class, general business focus. I'm not Elon Musk or Jeff Bezos by any stretch of the imagination, but I think that it's something that we don't focus on in pharmacy school based on feedback from a lot of our owners and things like that. It's not something that they got a great education on. I think that we educate people very well to go out and take a staff pharmacist position at a CVS or a Walgreens, but I don't think that we do a great job unless people are pursuing a minor or a double major in business or something like that. I don't think that we do a great job of preparing new students to go out and run a business, to be entrepreneurs. And so I find a lot of times that I run across pharmacists that are pharmacists first and business people second. And then, I would say the vast minority, I run across people that have 10, 20, 30, 40 stores, and it's very, very easy to tell that they are business people first and pharmacists second, and that's how they got their education on it. But you don't have to be a tycoon to practice good inventory management practices, to take care of what, the store that you're running and the people that you're responsible for there. And, we talk about this a lot, that this stuff's not necessarily incredibly difficult. It is simple, but it's not easy.
And Jared, we're running into a situation where pharmacists, a lot of times, especially the smaller ones with 2 or 3 stores, don't realize the impact that inventory has to their cash flow or lack thereof. When you've got $100 Franklin sitting on the shelf and not $20 Andrew Jackson's, it makes a tremendous difference with respect to what you have on your shelf, how quickly that inventory is turning, and how quickly that cash flow is moving in the course of your business. What are you seeing here with respect to cash management and the flow of inventory with a lot of the stores that you guys are working with?
One thing that I try to talk to my stores about is that I like this idea of, we buy inventory as an asset, right? Inventory shows up as an asset on the balance sheet. Is that correct? It's been about 10 years. Been about 10 years since I took any accounting classes, but I'm good that far. So that shows up as an asset on the balance sheet. However, it's not my view that every bit of inventory that we have in the store is an asset, because it is a finite resource. It is a resource that at some point or another, in my mind, morphs into a liability because it nears expiry, or it does expire, or for some reason a brand name goes generic and it's no longer usable, it's non-formulary with insurance and things like that. So there's all manner of stuff that can happen to our inventory. Sorry about that. All manner of things that can happen to our inventory that we bought as an asset that could cause it to become more of a liability to us. And so the best way to avoid that is to keep it on the shelf for the least amount of time possible, bring it in, send it out, and get as near to that just-in-time inventory that we see more in the long-term care and 340B arenas than in traditional retail.
And what do you see, Jared, with respect to expiration controls? We see way too many pharmacies that I hear being said we've got to pull things off we've got to expense these items because it's run out of expiration. Why does that happen so much? Why do we see that so frequently? And what can they do to mitigate that?
One of about two or three things, in my opinion. Most of the time, you're dealing with over ordering, so ordering product that you don't necessarily need based on how much of that product you use. Number two, poor stock rotation is the killer of all dreams. I can't tell you how many stores that we go into and they've got plenty of usage. They're not overstocked, but they're still expiring product because for whatever reason, when those new items come in from the wholesaler, they're not rotating stock on the shelves very well. And that's a habit thing. Like I said, good inventory management a lot of times is not difficult. It's simple, but it's not easy. And so going through those repetitive motions and doing the right things every day, even though they seem small, make the biggest impact over time. Another thing that we see in those would be the edge cases would be somebody has some sort of large brand name presence in a robot or some other sort of automation that when that item goes generic, they don't have a way to return it. And so that's one thing. I have seen that go poorly, but that's one of those that when it does go poorly, it's almost awe-inspiring because it's automatic that there's nothing for you to be able to do with that. You can't send that product back to the wholesaler if the stock package has been broken, one, and two, at that point, if your state allows MatchRx, you can't even sell it on MatchRx because you've put it in the robot, thrown the bottle away, and you don't have any way to verify what lot and what expiration is on that product. So, I mean, that is a scenario where you literally end up writing all of it off.
And that rotating the stock, I think, is a perfect example of poor management and hurting that cash flow when really, and correct me if I'm wrong, Jared, but it seems like just a standard operating procedure in the pharmacy on what to do when you're restocking, and just a simple rotate that stock is a simple procedure that could be put in place. I mean, am I right there? Or?
Absolutely. To strike an accounting term, FIFO, right?
Yeah.
First in, first out. That'll make everybody's hair curl because they'll be like, oh God. I hated that class in college, but it's true. If that's the first item that came in, and now I understand people are going to hit me. I'm going to get comments and text messages about this. Oh, I ordered something and it had less it had less dating than what I ordered 2 weeks ago. Every once in a while, but for the most part, when you order new product from your primary wholesaler, they're going to send it out in the order they got it in as well, because they're trying to get it off their books before it goes to expiration as well, right? So yes, when that stuff comes in, arrange it on the shelf by dating. You want whatever's going out of date first, closest to the front of the shelf, and we won't be using that stuff. We want to be churning through it.
And talk to us, Jared, about synchronization and what you see pharmacies doing that are maximizing that synchronization and how that impacts their inventory turns there.
Doing the work. One note I had further down, but I'll bring it out here, is that there's no magic spell that you can cast over your inventory and just make it, effortless and make it work for you. It's still a process. It's called inventory management for a reason. It requires that you focus on it and you spend some time on it. Synchronization is the single best thing that you can do to decrease your on-hand inventory and to increase your overall efficiency or inventory turnover ratio. And it's just, there's no substitute for it.
And cash flow.
Absolutely. Yeah. And so there's no substitute for that. And I feel like a lot of people, the feedback that we get on it when they don't want to get that started or have not yet gotten it started is, oh, but it takes so much time and it does this and it does that. And I think it's a delayed gratification thing. I don't think that you see a lot of the fruits of that labor until you get 1, 2, 3 months down the road and you get over a certain portion of your customers on a program like that, be that 10, 20, 30%. As you increase that, you start to see the fruits of that labor in the proactive approach to it. Cash flow looks a lot better. Phone's not ringing off the hook every day. It's really impressive, the people that take it by the horns and really lean on it.
Jared, talk to us about how you see the use of technology as a key factor in this whole process here, and what it can do to help the typical pharmacy that we run into.
Absolutely. I think the biggest way that technology provides us value is in time savings. And I know that's very that doesn't seem like a hot take or anything like that, but I do think that if I were to ask everyone on, everyone watching on the webinar now, and even both of you gentlemen, I think if I were to ask the question, do you think we have to do more now to fill the same number of scripts than 10 years ago or 20 years ago? I think the overwhelming, perhaps even unanimous vote would be yes, we do. So I think that the biggest thing that we can do is take back some time. And if we can leverage technology to help us perform menial tasks or something like that, even if that's a Parada or a Script Pro that's helping us fill 30-40% of our scripts a day, if that's leveraging people like us to take over managing a portion of your inventory, or to take over a certain thing that can help give you back time to spend more time being active in your community, reaching out to patients, and generally going out there and growing that top line revenue, letting some of your technology control expenses while you go out there and grow, I have seen be very, very effective for a lot of people, at least over the past 6 years.
We got a question that's come in here from Scott, and Scott is saying, what is the best inventory management for long-term care pharmacies where there are complex billing and rebilling scenarios which throw off a perpetual inventory data feed?
Man, how deep in the weeds do you want me to go? Long-term care has its ins and it has its own set of challenges. The great thing about long-term care a lot of time is, I don't want anybody to take this the wrong way. It's just a term to use. You have a captive audience. And the idea there is that creates just-in-time inventory. There's a lot more transparency with what you'll be filling next month for the beds that are already there. We can predict that. The healthcare is in-house, doctors seeing those people in-house. And so a lot of times you have some knowledge going into that on, we're going to fill this much of this item, this much of this item, this much of this item across all these beds. That being said, it can be a nightmare for trying to run perpetual inventory because some people pre-bill that stuff. Sometimes it's got to be billed the day it goes out. Sometimes it's got to be billed the day before. And I've seen it specifically with certain pharmacy management systems I won't call out, where they don't have a great, they don't have a great program for that. There is no way to bill that stuff out without removing it from inventory, or vice versa, before it goes out the door. And so it can be problematic. That's a very, it's very store to store, very specific to what pharmacy management system and what wholesaler you're using. However, ideally, in a utopian world, long-term care would be just-in-time inventory, because if you know that you're filling for patients next week and you have time to order that medication, compare that with what you already have on the shelf, you would never have a full package of anything left on the shelf in a long-term care pharmacy. If you were able to get it perfect, you would have only partials for whatever you didn't, for whatever you ordered a 500 count bottle, or you ordered a 100 count bottle, and you only had scripts for 70 of them. You would have 0 full packages on the shelf there, and that would be considered just in time. Everything's not in unit of use, so there's no way to get actual just in time. You can't stand there and look at your empty shelves and pat yourself on the back. But essentially, the closer you could get, the less inventory you would have there.
Mm-hmm. It's a good question, Scott, there. So we typically see around 11 or average, I should say, is around 11 turns a year, inventory turns. Clearly, we want to see pharmacies closer to that 20 turns a year. Jared, are these pretty consistent with what you will see in maybe a new pharmacy you're taking on that's struggling with inventory versus those who are really on top of it?
Yeah, absolutely. We've got several stores that are, I would say in the 20s and whatnot that we work with on a regular basis. Specialty and 340B programs can throw that off. And on the aggregate, I would say, but somewhere between 10 and 12 is what we see people come into our programs at. And then across the board, I think the average for our entire customer base is between 16 and 17 as of earlier this year when I did the last case study on it. So and I remove the outliers for that. I've got a couple of specialty stores that really kick it at 60 or 70 turns. And people will probably ask, and I'll cut this question off because people are probably going to ask about 60 or 70 turns. I've been kicking around the idea here lately, and I haven't really put it into terms where it's easily communicable. Otherwise, I'll write a post on it, or we'll get on and talk about it. But I've been kicking around the idea here lately of perpetual inventory really being a combination of two inventories. And I arrived at that over the thought of inventory turnover ratio and the way that we calculate people's reorder points and things like that. And I don't want to get real deep on that. I just want to kind of talk about the idea that let's not let our inventory turnover ratio hide inefficiencies within the store, because that is one thing that we see once we get into some bigger stores. They're doing a great job on their inventory, you're moving a lot of dollars, but let's not let other items sit on the shelf and hide behind that one piece of success that we've got there, that kind of gold star that we've gotten. Oh, I've got 20 turns. So, well, if you're in a specialty store kicking out, some $4,000 or $5,000 items, it's easy to get there. And you're not necessarily turning those items over as often as you
think. Scotty, talk a little bit about inventory and for tax purposes and what has been done maybe in recent years, what some of the new rules are, because I would imagine that impacts most people that are on this call.
Yeah, so generally, you have to report that inventory on your tax return. The Tax Cuts and Jobs Act threw a little gray area in this area for inventory and taxes, and it was just recently clarified by the IRS that no, you got to keep that inventory on the books, generally speaking, for tax purposes. And so we typically see we often see pharmacies that are not reporting that inventory on their tax return, and that could get you in trouble here going forward. So you need to be aware of that and make sure you've got that area addressed going forward, because that IRS regulation came out earlier this year on that. So speak with your advisors for sure on that.
So we know many pharmacies have switched from accrual to cash accounting since the Jobs Cut Act came out in December of 17. And if they have expensed their inventory already, what procedure will they have to go through to make that correction here for this calendar year, assuming they're a calendar year business?
Yeah, so if you have to make that adjustment and you have to get it back on the books for tax purposes, you pretty much tell the IRS you're changing your accounting method, if you will. There's a special form for that, and you get to spread out that income, because if you're throwing inventory back on the books, create an income event, if you will, and you get to spread that out over 4 years versus the IRS finding it, getting you all with that tax impact in year one, plus maybe penalties and interest. So you want to do it before the IRS gets there, and report that with your on the form 3115 is what it's called, but your advisors can certainly help you with that.
And that's something you want to plan for. If you've done this in previous years, you want to plan for that event to take place at the end of this year here as you go through your year-end tax mitigation process.
And we do have several videos and content just on this one topic on our website.
Yes, we do, on our website.
Hey, can I ask you guys a question regarding that? I know that was the hot button thing when we first started working together about 3-4 years ago. Was everybody needed to go to accrual accounting? Let's write this thing back. Let's do this. It was a great thing. I wanted to draw a distinction there, and I think that there's a lot of misinformation out there, and I don't think it comes from you guys. I think that it comes from people talking to each other and trying to help and trying to plan and things like that, and maybe from accountants that are not as well versed in the pharmacy space as you two are. But there's a lot of people out there that think that is a multi-year thing, and that it was not a one-time change it back, and then from there any increases or decreases in your inventory affect taxation. moving forward. And so I was talking to some folks the other day, and they were like, oh, well, you know, it doesn't matter because we wrote it back to this. And I'm like, yeah, guys, but that's not an every year thing. You only get to make a change of accounting principle one time. Is that correct, or is that incorrect?
Well, the accrual to cash changed. So prior to the Tax Cuts and Jobs Act, pharmacies, generally speaking, had to be on the accrual basis of accounting for tax purposes.
Right.
And the Tax Cuts and Jobs Act then said, well, if your average gross receipts for all your pharmacies, if you have multiple, are less than 25 million, it's 26 million now, gross receipts are less than that, you can use the cash method of accounting. And then it goes on to say, well, then you can also report inventory as materials and supplies or inventory. And when we're talking about pharmacies, materials and supplies versus inventory, however you want to call inventory, is essentially the same thing when you look at the regulation and the law there. So what you had though was some pharmacies say, well, I'm going to call inventory materials and supplies, and then there was a reg in there that says if essentially a de minimis exception for materials and supplies that allows you to write off that inventory or / materials and supplies. And so the IRS came back and said, no, you cannot use the de minimis exception to write off materials and supplies for what is essentially inventory. And so they reversed that or they clarified that, if you will. And so that's where pharmacies are now. And as far as what you're talking about, Jared, you're correct. I mean, when you go from accrual to cash, that is a one-time event. Now, if you go from cash to accrual, that's a one-time event. I mean, it can be done annually, I guess. But I may need to correct me on that, but it is a one-time event when you're switching accounting methods. That's right.
Sure. Yeah, I think there was some confusion, and I've talked to multiple people about it, that just out in the, I guess you would call it the social media sphere, about that was going to be something that they were able to do over and over and over and over again. I was like, guys, that doesn't help you because of the way that.
Yeah, you're not going from accrual to cash, and then at the end of the year you're going to accrual to cash, and at the end of the year you're going to accrual to cash. I mean, when you go to accrual to cash for tax purposes, you're on cash that year, you're on cash. So it's a one-shot thing.
And frankly, when you move from accrual to cash for tax purposes, because we always here use accrual-based accounting each and every month and at year end, because only accrual-based accounting really lets you know what you're doing in that pharmacy. But if and when you move to cash-basis accounting, and you're allowed to because of your sales, you can frankly, like a farmer does, if you think about that, a farmer a lot of times will pay his expenses in February for the spring. Same type of situation. You can plan your cash outflow in a latter part of the year and control your taxable income a heck of a lot easier than when you're on a full accrual basis. So you've got much more control over what your taxable income is going to be on a cash basis, although cash basis accounting does nothing to tell you what you're doing in that pharmacy, Jared. And this is where a lot of people have gotten themselves in trouble, where they've gone to cash and they really are trying to figure out where they are, and they don't know what their receivables are. They don't adjust inventories. They don't adjust payables, all the things that affect accrual-based financial statement. And there's a lot of confusion in the industry about this, especially by folks that are not familiar with the pharmacy model.
Yeah, and when we make a change to cash accounting, which you certainly want to work with your advisors before you make that switch.
Yes, you do.
It's not an automatic for pharmacies. But should you find out that you should be on the cash method or can be, we're still keeping the books and records on an accrual-based model. So each and every month with financial statements, you're looking at full accrual statements so you can know exactly what's going on in your pharmacy, because that's going to give you the best picture of the performance of your pharmacy. But at the end of the year, there's some technical accounting adjustments that are made and a reconciliation. There's a full reconciliation process to go from the accrual to cash with pretty much 2 accounting journal entries. And so you just have to keep up with that. And that's where it can get a little confusing, and we see a lot of issues in that area. All right, let's go through an example. So this kind of small example, but we'll kind of be able to see how this inventory is important. So the pharmacy had revenue of $425 for the month. They purchased $1,000 of inventory for the month. So we're going to increase an inventory account $1,000. We're going to increase our accounts payable, what we owe the wholesaler $1,000 at that time. And at the end of the month, the PIC guesses that the inventory balance is around $725. So if we went from $1,000 inventory down to $725, that means $275 must have been sold. So that's going to be your cost of goods number there. And then minus your revenue minus the cost of goods is going to be $150 or 35% gross profit. And then if we go to the next one, we're going to have the same exact example, except at the end of the month, there's actual physical count or a good perpetual count in there. And the inventory balance is actually $675, not $725. And so that means $325 difference between that $1,000 inventory that was purchased and what's left on the shelf at the end of the month of $675. And so that gives us $100 gross profit or 24%. So we can see here, this is just a good example in small dollar terms, but if you magnitude this, and inflate this with thousands of dollars, thousands of transactions here, you can see where this can be a huge difference in the gross profit of the pharmacy, how well your pharmacy is performing, your bottom line in the pharmacy, your tax liability in the pharmacy. So this is kind of gearing in to show you how important reporting inventory is and how that can really impact your financial statements and your analysis of how well your pharmacy or how well your pharmacy is doing.
And Jared, it's amazing how many pharmacies we see have just this particular issue when we look at their financial statements for the first time. They come in here, they have margins that are either extraordinarily low or extraordinarily high as a result of not really knowing what that inventory number is, because they probably don't use a service like yours. And they end up paying way too much or way too little income tax. And then as those numbers are adjusted, because we typically will force them in a nice way to take an inventory ultimately, and then we make those adjustments, they can't believe the number of adjustments on the P&L that are affected. We see that more times than you can check a stick at. It's unreal.
Something that I see quite a bit, which I guess I don't see it because I'm not the accountant on it, but I hear about it secondhand quite a bit after we've done account for somebody is, oh man, I was overstating inventory by $100,000, or I was understating inventory by $100,000. I'm like, how many years has that gone on? When's the last time you got it counted? What were you basing that off of? And a lot of times that comes from people saying, I will get people that tell me I haven't had it counted in 10 years. I haven't had this. I'm like, well, how did you get to the figure that you're at? And they're like, oh, we were just adjusting it, at the rate of inflation. We were adjusting it 3% a year for the last, we were adjusting it 5% a year. I'm like, at 7% a year, it doubles every 10 years, right?
Mm.
Like I mean, I don't understand, but I don't know how people pick that arbitrary value, because I understand you can read the reports and you can say, oh, drugs on the aggregate went up 2.5% this year. But that doesn't mean that the drugs in your store went up 2.5%.
Yep.
They may have gone up 3.5. They may have gone down a point. That before everybody crucifies me for saying that, generic drug costs last year actually decreased in cost for the first time in forever. But it happened. So don't at me on Facebook. But yeah, I think it's wild how people would just like shot in the dark. It reminds me of Christopher Columbus looking for, the Spice Islands and finding America. We got the compass off 1 degree, and you're just going further and further and further and further in the wrong direction.
And then to magnify the issue, they say, well, I want to sell my pharmacy in the next year or two. And then we may be advising the buyers coming in and say, okay, give us the last 4 or 5 years of your books and records. And we see this inventory all over the place and margins, 1 year high, 1 year low. And we don't have, the seller doesn't have accurate information. And if we're representing a buyer, I can tell you as a seller, that's not going to help you at all in terms of valuation. So again, if you're nearing retirement, you need to make sure your books and records are in play, in order. You need to make sure your inventory is accurate, your receivables are accurate, your payables are accurate. It will ultimately end up costing you as far as your valuation is concerned. Because I can tell you, when your wholesalers do your valuation, quote unquote, they're taking your tax returns. They're not digging down in your books and records as we would. They're going to take your tax returns, and whatever numbers on your tax returns is the valuation you're going to come up with. All they have an interest in doing is keeping you as a customer, period.
And you said nearing retirement, so give us a time frame of what you mean.
4 or 5 years. I think 4 or 5 years prior to when you are looking at retiring or selling out, you better have your books and records in order and better be doing physical and perpetual accounts without question on an ongoing continuous basis.
So moving on to that, physical counts. Jared, I'm going to let you take most of this. You're the expert in this area, but you know, we typically want to see those counts in third or fourth or early fourth quarter. When we do, we were just talking about this before the webinar started, but a physical count on the last day, December 31st of the year, is not strategic planning on behalf of you, the owner, and the pharmacy. We got to have those adjustments in before the end of the year so we can see what they are and plan accordingly if there are some material adjustments to the books and records and your net income, so on. So want to see those counts done before the end of the year. If we need some data points, if your pharmacy's really in rough shape or we got to really tie down some things, we may want to get a couple physical counts a year, those data points. We want to see that linked to some degree with that perpetual system. And Jared, you can certainly probably expand on that more than I can. And obviously there's companies in the market that specialize in pharmacy inventory counts, and we're speaking to them. So Jared, what do you want to add to that?
Well, I wanted to ask a question because I don't think that people understand this as a strategic thing, because majority of the time when I talk to people, they either have gotten, you've twisted their arm, or somebody else has twisted their arm, or we're doing a transition of ownership or something like that. There's so many reasons that we count inventory. My question would be, what are you guys looking to adjust when we do that? You know, that end of September, I'll have several counts coming up. I think several of them for customers that we have in common. In the October timeframe, it'll be rolled back to the end of September. So my question is, what kind of red flags are you looking for there, and what kind of difference can it make on how that person comes out at the end of the year versus if they got it the last 5 days of December and you lose that planning opportunity? Because I think most people look at it as, oh, this is just something I have to do. Jared's making me do it, or Ollin's making me do it, or Scotty's making me do it. I don't understand it, but you know, tell me a little bit about like what you can do when you've got 2 or 3 months to make those.
It's pure and simple. When we have an accurate, let's say you come in there on October the 10th and you back it up to September 30th. And you give us a number, and let's say you did the same thing the previous year. We know then we've got 2 data counts within the last 12 months. So most likely, if all the returns and allowances have been booked properly and expirations have come off the shelf, et cetera, we probably have got a really good reading on what that gross margin is for that 9-month period of time, assuming it's a calendar year S corporation passed through it. So if we know exactly what those numbers are for that 9-month period of time, and let's just say that number is 23% for that calendar year. And let's just say we've been estimating 22% during the year. Then it's going to be the gross margin and P&L are going to be adjusted upwards by 2 percentage points. So if we're a $5 million store, that's a $100,000 adjustment to P&L or profit right there. So that's incremental income that we've got to factor into the tax planning model for the last 3 months of the year. And because we've done it in mid-October, then we've got the needed information in order to plan timely for where it is we want to be at the end of the year. And then it's complicated by the fact that if we've already switched from accrual to cash basis accounting in prior years, we've got even more flexibility here and more options as far as getting you, the pharmacy owner, where you want to be as far as your taxable income is concerned
Right.
at the end of the year. Pure and simple.
Right. So once we had that good information in the books and records, we know the numbers are tied down, and we know what we're working with for tax planning. And you got a myriad of options that we're going to be looking at: retirement, charity, whatever it may be, to maximize the situation, to mitigate tax, and to help the pharmacy with cash flow with the silent partner, the IRS. So we're taking inventory from a cash flow perspective on keeping cash in the bank, not the shelf, but we're also it also is going to expand here when we're talking about the IRS and mitigating tax liabilities with the IRS. So and getting that keeping your cash in the bank there. So that's really what we are after when we do that. And contrary to that, if we're doing it at the end of the year and we get those adjustments from you in January of next year, there's things you cannot do in January that you could have done in November, October, December of the prior year to mitigate tax, whatever it may be. So you have to proactively attack this, if you will, and that's what we're after.
And those adjustments and those planning ideas that Scotty and I are talking about way more than mitigate the cost of your service for getting this done.
Right.
So the cost versus benefit is fabulous return.
Right. That's where I was trying to get, because I think that a lot of times, even customers that we share, I call them and go, hey, look, we really need to get in there. You guys aren't going to know where you are. Scotty Ollin, they need to know. All of the crew over at the site, Sykes and Company family, they need to know so they can help you out. And folks are like, he's just trying to get me to count it earlier because he's going to be busy in November and December. It doesn't matter when I come count your inventory, I'm going to be busy in November and
Correct.
December. We'll be busy in January.
Correct.
It's about to crank up here, and it's going to get wild and crazy for the next 4 or 5 months. The thing is, when I call you guys and I tell you, hey, let me get in there, let's get this thing counted, anytime in the third quarter, I would say mid third quarter to the first, October, really is a great planning opportunity for you and for your store and for your business. And it's not something that I'm doing to try to help me. It's something I'm trying to do to help you guys, because I get feedback from Ollin and from Scotty and say, hey, can you get in here and get this one knocked out? We need this one done. And so I'm constantly trying to get, in kind of that sweet spot so that there are options.
And again, if there's that $100,000 adjustment at the end of the year that was not anticipated, you're going to be like, well, we got an extra $100,000 here. We got to, there's not a lot of options we can do to mitigate this or plan around this.
Yeah, you're going to end up buying that.
We're not going to have that with strategic, proactive tax planning that involves physical inventory counts before the end of the year.
Instead of having a long period of time to plan for that, you're going to end up buying a Parada or something on the December 29th to try to, not get mollywopped over the back of the head with something, because the only option you have at that point is increased expenses.
And good luck on getting it installed and in use.
Right. So perpetual inventory here. If you would, anybody out there listening in, if you please put in whether you guys have a perpetual system or not in your pharmacy. If you do, are you confident in it? If not, why not? But if you'll just throw that in the chat box, that would help facilitate the discussion here. But perpetual inventory, Jared, is obviously something we continue to see more and more pharmacies adopt, rightfully so. But it is vital for several reasons. Why don't you give us a little? Why don't you touch on that perpetual for us?
And of course, Devin says here, yes, it's been way better since we did. Scott says we use perpetual in our retail and long-term care. Bonnie wants to know what percentage of pharmacies did she see that actually have perpetual system. Jared?
Ooh, I would have told you.
That's a Bonnie question.
I would have told you 4 or 5 years ago that it was around 20%. I think out of necessity now we're nearing that 35, 40% metric, but I still think it's under half. I really do.
Yeah,
Um, I,
it is. It is.
I think it's far less than half. I think it's a material amount less than half. And I think more people are going to it out of necessity, most importantly. I also think that as we see the kind of the older guard of independent pharmacies start to move out, one thing that I get feedback wise from a lot of people in their late 60s, early 70s is that, Jared, I got 5 more years. I've been doing this for 35 years. This one way, I've got 5 more years. And I'm not going to lean on somebody super hard for that. By definition, we're all independent. We want to do things our way. I totally get that. But I do think that it's the best way to do things, obviously. So I am going to try to nudge people in that direction. However, I see a lot of people saying, "Hey, I don't understand it. I don't want to make that transition. I don't want to do this. I don't want to do that." I think fast forward that 5 years, somebody in their mid to late 20s, early 30s buys that store. I think that their capital structure looks a lot different than somebody that's been in business for 30 years. And I think that's a big thing we're seeing. I know people now that are in their late 20s, early 30s that have bought a store, and out of necessity, they have to have it so that they can manage that inventory more closely to the best, because they didn't, their predecessor did not have the overhead. When we talk about bills, we talk about drains on cash flow. If the building's paid for, the business is paid for, all you're worried about salaries, it's just like having a paid for home under your personal finances or something like that. There's a lot more margin there between what you earn and what you have to pay out. And I think that by definition, early on, when people get into business, that's a little tighter. And so they're looking for opportunities to manage things as closely as possible. I think some folks that have been around for a long time, they don't have the same bill structure, and, that they don't necessarily have to manage it as tightly.
Our friend Tom says we do, but in high volume store, it's very hard to keep straight. The indices changing out of stocks all throw wrenches in the mix. And I know Tom has a high volume store, so that's an issue for him. Any comments on that?
Yeah, I think I've spoken to Tom before. Good to talk to you again, Tom. Hey, Tom does have a high volume store, and that's true. The good news about a high volume store is that you're moving a lot of cost of goods out of there. It's easier to do a higher number of inventory turns, because you are moving so much product through the store. And a lot of times in a high volume store, like we were talking about earlier, you can hide some inefficiencies, but if you can run a high volume store efficiently, you can really, really pile some money away in terms of net income. I would say the great thing about high volume stores is that you can typically afford to pay somebody to take ownership over the process, or you can reach out, have some outside consultants, see how they could help you with something like that. I know some people that have smaller stores that wish they had that problem. And I understand that volume magnifies issues. We see that quite a bit. If contract changes are a problem for somebody doing 100 a day, they're at least 5 times the problem for somebody doing 500 a day. But I think in that situation, we got to count our blessings as well. It's nice to be doing 500 a day, and then let's see how we can make it work for us.
And Devin says he's a Pioneer user, and he does audit counts and quarterly does complete counts. So Devin's got it completely figured out. Devin, the only other thing you need to make sure you're doing is making your adjustments on your accounting system monthly. And as efficient as apparently you are, you probably are already doing that. So just keep that in mind. Scott also says Perpetual does not seem to cut back on owes to customers. What are we doing wrong?
I think you're focusing on how much of that. I think you're focusing on how much product you can trim down instead of bringing order points to equilibrium. So that's a big misconception. When I talk to people, a lot of times they go, "Oh man, you're gonna come in here and return $45,000, $50,000 worth of product, and we're not gonna be able to fill for Miss Johnson down the street for blood pressure medication." And that's not the idea of perpetual inventory. What you're looking for is a return to equilibrium, which means that some of these items you're understocked for. Some items that you're moving out the door, we should never run out of simvastatin. We should never run out of atorvastatin. We should never run out of gabapentin. It's not worth it. It's not worth not holding a little bit more of a cheap item to make sure that you cover those big days, especially if you've got a growing store that over time, that's where the majority of your growth is going to be, is in those maintenance medications. It's not worth missing that prescription. You wouldn't notice the difference. And I know we talk about inventory turnover ratio, and I touched on this a little bit earlier, that's a financial ratio. It's not physical in terms of how many tablets are you turning out. It's financial in terms of how many dollars are you turning out. And that's why keeping a little bit extra of your maintenance medications, your low cost generics, it doesn't hurt you. You know, you could keep a whole case of simvastatin in the store, never touch it, you know, let it go out of date in the back room. And I'm not advocating this. Don't come at me about that. I'm not advocating that. I'm just saying when it comes to turnover ratio, it wouldn't add up to one bottle of some $500, $600 medication, or, you know, a Trulicity sitting in the fridge that's stuffed away in a drawer, or, you know, a Truvada that got knocked over and is on a shelf where it's not supposed to be. It doesn't calculate. So a lot of times people are trying to run things too lean when they've got too many O's, and they're focusing more on what they can minimize as opposed to making sure that some of the cheaper things are taken care of.
So that sounds like, which would also involve those reorder points, you know, crafting those reorder points, using technology to do that, finding that equilibrium, supply and demand. And technology, Jared, you know, obviously plays a big role in that.
Absolutely. And I think focusing on what is specific to your patient base. I think that a lot of times people want to go off subjectively how they feel, what they should keep. I can't tell you how many times we pull an item for return in a store, and you know, I passed 3 people on the way on the tote that'll tell me, oh, you know, Mrs. Johnson, she gets that every 4 weeks on the dot. And I go, I'm not trying to argue with you guys, but Mrs. Johnson hadn't got this since January of 2020. And they're like, no, we just saw her. And I'm like, you did, but she didn't get this. You know, so it's one of those things without looking at everything. Well, you know, we're human. We have biases, and we draw back on those memories and things like that, but we're not perfect. And that's why I think it's a big deal to let the pharmacy management systems that we pay for, you know, the software that we pay for, any kind of robotics you got in your store, you know, let your advisors work for you and things like that. You can't do it all. You know, you can't remember it all. I see people have great performance running inventory without Perpetual 100 scripts a day because they know everybody that comes in the door. You know, this is not everybody. This is people with a good memory. Everybody knows somebody like this. Is no way. But they know everybody that comes in the door. They know their situation is, where their kids went to school, the whole 9. They grew up in that area. They know everyone, and they can keep it right. And then you see them get over 100 scripts a day and 150, and you start seeing a little that kind of waste creep up because you just can't physically do it. So, I mean, take the resources that you have available to you, the things that you pay every month for, and let them work for you.
Some good points there, Jared. As we get towards the end, it looks like we got about 5-6 minutes left. Jared, you want to run through a couple of these slides and maybe touch on what you guys are doing or offering to potential pharmacies out there?
Yeah, and I know that we're tight on time. I mean, this whole slide can be summarized in that first line right there: inventory solutions customized per store. You know, we talked about independent pharmacy as being independent by nature. That's why we got so many buying groups. You know, if in essence, if we were to put every independent together, we'd be bigger than the chains, but we can't because we're independent. So it's a double-edged sword. Essentially, what we strive to do is we go in, we help people set up perpetual inventory systems that are struggling. We help people transition that don't have any idea of how they're going to transition. We handle any kind of wholesaler transitions you may have. If you need help post wholesaler transition, we'll come in and help you. If you're looking to move to a new pharmacy management system and say, well, I've never done Perpetual before, but once I get over to that new system, I really would like to get that set up. I know it's a great system. It's got a lot more functionality than what we're used to. We come in, help do that, put everything on Perpetual, set your order points, look at your usage, train your staff on how to send and receive orders, and then how to manage that system once our team has left. The big thing that I wanted to hit on is right here, and that's inventory mining. In March of 2020, we realized that we were very, very susceptible to being able to travel. You know, we have over 400 stores in 33 states. Trying to get to 50. The running joke is that Alaska will be our last one, and the guys are concerned about me only buying a one-way ticket to get there because I've always wanted to go. But we found that we really needed a way to provide people value every month. This program was born as a request from one of our customers that's quite a ways away, and the travel was cost prohibitive for him, but he loved the analytics. And so what we're trying to do is touch people more consistently, provide value more consistently, touch them every month, do something extraordinarily efficient with relation to time and money, and keep our guys out of the store if the store can make sure their counts are accurate, and we can direct them toward different opportunities through data analytics. And so this has been an incredible ride on this program. We just started, really leaning on this back first quarter of this year. And we were going to do 100 spots. We've got about 40 spots left on this thing. And the problem with that is that I've got guys in here, they work on this program. That's all they do. They've been managing inventory. I think our inventory mining team has just under 2 decades of inventory management experience between them. So they know what they're doing. They've worked on 10, 12 different systems. They work with every wholesaler you can think of. So they got a good knowledge base, but I mean, this thing has been awesome. It's been the most impactful service that we have ever offered. It's extraordinarily efficient with relation to time and money. We got stores that are spending an hour a month with these guys. They're paying $300 to be on that program. They're getting $1,500, $2,000, $3,000 a month, just on data analytics, because we're looking at the things that you don't have time to focus on. We're looking for opportunities to send items back to the wholesaler. We're looking for opportunities to transfer them between your stores. We're looking for opportunities, to minimize what you're holding on hand for something that you may be keeping too much of. So if you're interested in this, guys, the analysis is free for this. I can tell you exactly how much of your inventory is working in your favor and how much is working against you. And when I say working against you, I mean items that are sitting there that are not in use, that are essentially costing you money when it comes to an opportunity cost of doing something else with your money, or when it comes to that item goes to expiration and it eventually does actually cost you money. So I would encourage everybody to do that. That's the best picture that has ever been taken of me, so I had to throw that in there. I never look like that. I'll never look like that again.
Handsome man. So if you've got some, if you want to follow up with Jared, there you go, right there on the board. Real quick as well, Sykes Company does offer an RX assessment service as well. This is a third-party overview where we take your accounting file, your tax returns, do an overview of that, deep dive overview, get you on a video call, go over the balance sheet, P&L, your tax returns, give you some feedback directly, what we see, good, bad, and indifferent, some opportunities or anything like that. You will walk away with some actionable items that we identify, and give you some peace of mind on where you stand currently with your pharmacy and what you need to do. If you have any questions, always reach out to us at Sykes at Sykes-CPA.com. We'll get back to you really quickly, usually with that, and we'll do everything we can to help you. But we appreciate everybody being on today. Look forward for our next Master the Margin webinar fairly soon, and we hope everybody has enjoyed today's webinar. Jared, thank you again for joining us.
Thank you very much, Jared.
And we hope everybody has a great week. Thank you.
Thank you so much for having me, guys.
Yep.